Welcome to SB Talks. It's Wednesday, August 30th, and I am joined once again by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vincent.
Now, Nick, as we record here, the latest Australian inflation data is hot off the print. What is it telling us?
Yeah, so we got the monthly CPI data for July, and as we've spoken about before, this doesn't include everything that comes in the quarterly print, but it does give us a bit of a feel for the inflation pulse. So we saw it fall from a downwardly revised 5.4% year on year to 4.9% in July. So
okay, and I think some of the expectation there was around the low fives, 5.1, 5.2, so even a bit lower than consensus forecast.
It was 0.3% below expectations. So the expectations were about 5.2. So yeah, it was pretty good. Although I think a few commentators had been a little bit cautious. There is some seasonality in the data, and as it's a fairly new series, people aren't quite sure, what impact that might have.
So just to reiterate on that one, usually Australia has the quarterly inflation data, which is sort of the main core reliable point. They're sort of gradually building out this monthly index, but it's still new, so there probably isn't as much history to refer to in terms of giving confidence to the numbers. Yeah,
that's right. I think they've only reproduced it going back about 5 years, and it only measures about 40% of items in the big quarterly CPI basket.
Any standout elements in terms of what you've seen in that number?
Yeah, so interestingly, electricity or energy prices were up 19% just in 1 month in July. Right. So as many of us who pay electricity bills know, they were going up in July, and they certainly did. But there were a bunch of rebates that certain eligible households were able to get. So the net impact for inflation was only a 6% increase for July after they deduct the rebates.
From electricity prices.
Yeah.
Anything else stand out in that basket?
Yeah, rent. That continues to be an issue. So annual rent inflation went from 7.3% in June to 7.6% in July. So still that theme of accelerating rents, or certainly, rent is a problem. Some people have suggested that because of the one-off nature of the energy price spike in July, that maybe inflation in the coming months mightn't be as good. Because of some of those seasonal factors and one-offs and things like that. The one that people are now looking at in the monthly is what they call the ex-volatile items and travel. So we know travel's been very volatile, airfares in particular.
What else sits in that?
That also removes fuel and fruit and vegetables, which are obviously also volatile
very
items.
Very seasonal as well.
Yeah, and very seasonal. So that actually also sort of heading in the right direction, but not down as much, 6.1 to 5.8.
So what you're really trying to do there is strip out any of the items more at the extremes that might have dragged it or artificially be clouding the picture. Yeah. So broadly speaking, we're seeing, I guess, a continued easing, but early days, still a bit tentative.
Yeah, it's 6.1 to 5.8 is not a big decline.
Yeah. And it's still quite a high number.
It's still a very high number. Yeah. It's still well above the 2% or 2 to 3% target range.
Yeah. When we're celebrating inflation potentially dropping just below 5%, we've still got a long way to go to target. Also, some details come through with sort of retail sales in Australia in July. Discussion of a bit of a Matilda's bounce in sales?
Yeah, so retail sales for the month of July were 0.5%, which was above economist expectations, and people are saying that might have been due to some of the sort of end-of-year sales and also the Matilda's effect, people going out and spending a bit more. But overall, if we strip out food over the year, retail sales just up 0.4%, so not a big increase, particularly given inflation. Ex-food retail sales spending only up modestly over the last year. So, really maybe suggesting that the consumer is pulling back on retail sales. But retail sales, mind you, don't capture a lot of the services side of the economy.
And what we've probably seen, and certainly it's been a bit of a focus in the States, is that let's call it the fight against inflation, good prices have probably the price of goods has started to come down quicker than certainly the price of services. And yes, there was a bit of that because you had sort of supply constraints 12, 14 months ago that were exacerbating the price problems. But we know that probably good prices are move more quickly, and some of the services prices, such as the flow through from rents and other things, can be more lagged to interest rates. So
yeah, absolutely.
A similar theme here. Okay, well, I guess that gives us a degree of confidence that the Reserve Bank meeting next week probably likely to have no news.
So market pricing is just 1 basis point, so essentially no change next week from the RBA expected by the market. And we had RBA's Michelle Bullock, who will take over from the 18th of September.
Yeah, so she's not presiding next week, but then will from that point forth.
Yeah, and she gave a speech yesterday, which there wasn't a lot in there, but she said they're taking decisions for the time being until next year, at least month by month. So very much that data dependency theme coming through from her.
Okay, well, on that theme, then the data just probably gives them more time to at least sit back and watch how the trend unfolds.
Absolutely.
We step across the Pacific, across the United States. The end of last week was sort of a big event in terms of the central bank calendar in the States, the Jackson Hole Symposium. In the last couple of years, I think 2021, Fed Chair Powell went there and sort of made the speech around transitory inflation that sort of he very quickly had to backtrack from. 2022, it was a very different message. It was one much more of tough love, and we'll pretty much do whatever it takes to bring inflation under control. And that last year spooked the markets with, I think, the S&P 500 down about 13% in the 2 to 3 weeks that followed. What did he have anything of great substance to say this year?
No, not really. It was very much on script for Chair Powell. He said they'd proceed carefully, they'd raise rates further if appropriate, we'll keep it at it until the job is done. He said that if there was persistent above-trend growth, that could warrant tightening, and very much stuck to the, we're sticking with a 2% inflation target. I think some people are suggesting maybe they might back away from that, but he was adamant that they're still 2% is still where they're going to. And there had been some hope that we might get a bit more colour on what they call R star, or the neutral rate of interest rates that neither accelerates nor slows the economy.
And is that of interest because people are trying to work out when the rates start to get cut, where are they heading to?
That's right, exactly. And he didn't really give away a lot about that. He said that it was still quite uncertain as to where R star is. But he believes that rates are certainly restrictive where they are today. And
very much playing his cards close to his chest there, I think. Also probably wanting to allow themselves the flexibility. I guess he was very clear about we can raise further if we need to. Do not absolutely think that we're definitely done. But they've probably got the room now to give it time and see how it plays out. We've had some jobs data, some other consumer confidence data in recent weeks there as well.
Yeah, so we got the job openings and labour turnover survey for July, which is being closely watched because it shows how many job openings there are in the economy. And this had been running at about 2 times the number of unemployed people. So for every unemployed person, there were 2 job openings. Now that's come back down to about 1.5. So that's very encouraging news. Job openings fell from what was initially reported as 9.6 million openings to 8.8. So certainly heading in the right direction, really sort of reinforcing that soft landing scenario where job openings fall, but people don't necessarily lose their job. So it makes the job market less tight. And there's another thing that people look at in that survey. It's called the quits rate. It's the number of people voluntarily quitting their job. And that fell.
Is that people removing themselves from the workforce, retiring? What feeds into that?
They could be usually going to another job.
Right, okay.
So often, they quit their job because they've got another one to go to, or they think they could get another one. So it's usually a sign of tightness of the labour market, often correlated with wages on a lagged basis. So if a lot of people are quitting, it's showing that there's a tight labour market and wages often go up. But what we saw this month is the private quits rate fell from 2.7 to 2.5. And that's more or less in line with where it was pre-pandemic.
Okay.
So some encouraging news there.
That their tightening is certainly starting to have its effect, even at the more lagged part of the economy.
We also get the Conference Board's measure of consumer confidence for August, and that fell 8 points to 106. But more interesting, one of the questions they ask in that survey of consumers is whether they think jobs are plentiful or hard to get. And the ratio of people saying the jobs were plentiful to hard to get fell to the lowest level since the pandemic. So more signs that the labour market is kind of coming back into balance, which would be encouraging for policymakers.
It's this everything you discuss about is an indication of a deteriorating economic climate, and yet we kind of go tick, that's good news, that's good news, that's good news. And that's what the equity markets have done in the last few days as well. These negative economic indicators or data reports have pleased the market. It's the old bad news is good news for the market, because we think, okay, well, maybe the Fed's definitely done and there's a chance that they cut sooner or more next year, and the equity markets have certainly seemed to like it.
Yeah, no, absolutely. But it's bad news in the sense that there's fewer job openings and people are less, I guess, optimistic about the labour market. But it's not bad news in the sense that people are losing their jobs. And we'll find that out on Friday night when we get the non-farm payrolls report for July. So that could actually paint a different picture.
And might step across to China. You wrote about this recently in our latest SB News, and question marks continue over, is China's growth story done? That we've talked about the declining population before. How does that feed through in terms of their broader economic growth miracle?
Yeah, well, I think they've got three real headwinds that the Chinese economy is facing into. There's a scarred consumer because of those very stringent COVID lockdowns. So the consumer consumer confidence is very weak there. People have been saving instead of spending. That sort of post-reopening bounce didn't really happen, or it was very short-lived. Yep. So there's that. There's the property market, which we know has had problems for a number of years, particularly after the government introduced sort of tighter lending for property developers. And we saw that China Evergrande with $300 billion going to default and bankruptcy. Another big developer, Country Garden, has got some financial issues. So the cracks are really, have appeared and are probably getting worse.
And we have that demographic headwind coming
and property is accounted for a quarter of the economy. So it's a big sector in China. And so if prices are falling and property developers are going bust, and also that feeds into consumer confidence. A lot of people's wealth is tied up in property, so it's a problem. And if those
engines of growth, infrastructure and property aren't there, where does the growth come from?
And as you mentioned, we just spoke about goods demand in the West, and even in China, people just aren't buying Chinese manufactured goods at the moment. So that's the third sort of problem for China. And people talk about this liquidity trap where even if the government cuts interest rates, which they have by a small amount, it doesn't really do much because people are still very bearish on the near-term prospects for the economy, so they don't want to spend, and businesses don't want to invest.
Yeah, so if people have low confidence, it doesn't matter what the rate is, they're still just not going to take the risk.
And foreign observers had been hopeful that the Chinese government would announce some huge stimulus program and basically hand money to households like, we've seen in other countries. And it appears they have a philosophical opposition to doing that. And so we've seen very piecemeal stimulus announcements from the government.
Which has seen, I guess, a lot of commentators start to, turn less and less optimistic towards China as a source of investment, and increasingly focus turned towards places like India, which is a much more attractive demographic pathway and I guess much more early on in its economic growth journey as well.
Yeah, well, the US Commerce Secretary is in China at the moment, and she mentioned on the newswires that a lot of people are saying China has become uninvestable. A lot of US businesses don't want to invest there. The policy environment's
geopolitical
uncertain.
Risks are very heightened.
That's right. So it's a headwind for China.
And I guess a big consideration for Australia, where China and certainly for a resource sector has been a big driver of demand over the last few decades, albeit I know that someone would say Japan was there before it and then China stepped into the breach and potentially India comes next down the line or Indonesia. There's still plenty of growth in the region.
Yeah, absolutely.
The last time we spoke, we discussed reporting season, which was wrapping up in the States and sort of kicking off in Australia. What are we seeing in terms of the trend there? Is it how are companies reporting through this economic environment?
Yeah, the reporting season in the US, Europe and Australia has been pretty good. So the number of companies sort of beating analysts' expectations has been either in line with average or ahead of average, long-term average. So, some of that was due to, I guess, downbeat expectations. So there were low hurdles to jump over. But generally the results have been pretty good, particularly in the consumer discretionary sector where people had expected retailers to have a difficult time, and that hasn't been the case. But I think the interesting thing, particularly in Australia, is not so much that the earnings have been okay, it's the guidance, the forward guidance, and that's been very negative in Australia. And
so in terms of the companies that have reported for the year just gone, but their guidance for the year to come
correct.
Has been pessimistic,
conservative. And perhaps it's management being overly conservative about the outlook. Or perhaps it's real problems that they're seeing with the higher interest rate environment and the cost pressures and all of those sorts of things. But certainly we've seen earnings expectations for the 2024 financial year being shaved over the last few weeks as reporting season's taken place.
Because equity markets, certainly offshore, have had a very strong 2023. Australia probably a bit more modest, and that's because tech has probably been one of the biggest drivers, as we've spoken about on the podcast before. Where do you sit right now on if on the Nick bull versus bearish case range? Where are you sitting with bond yields, where they're at the minute, with reporting season beginning to wrap up around the world and the economic picture becoming a little clearer?
Yeah, I'd say it's still, in terms of growth assets, equities, probably still net neutral. Happy with that position for the time being. As I've mentioned on previous podcasts, bonds are becoming more attractive, so probably looking to add there and take money out of cash and things like that to extend the duration. And I'd say that's still the case. I don't think there's anything that's come out of reporting season that would necessarily change that to a major degree.
So I guess you're really sitting neutral. You're happy with a diversified portfolio, a role for equities, a role for bonds within there, and a role for alternatives, but not so confident that you'd want to be overweight equities or adding more cyclical exposure at this point in the cycle.
No, and we've seen equities pull back in August, so they're down certainly the US market was down until about 3 days ago.
Down 8 at a point. So recovered some of that.
It's recovered in the last few days, but it's still down a couple of percent off recent highs. So I think it's fine.
It's probably a little bit of rationalization there at the end of reporting season after a terrific run up to that point.
Yeah.
Any other items you'd like to call out?
No, I mean, I think the things to watch out for, non-farm payrolls this week. We get some PMI data out of China, some inflation data out of Europe. I think that'll be interesting. I think people aren't quite sure in Europe whether the ECB has one more rate rise left in it. So that'll be interesting to see what happens with the European inflation picture.
Yeah, I think you got German inflation data tonight. It's a big one there for the ECB.
Yeah. So they're the key things I'm kind of looking at over the next week or two.
Exciting times indeed. All right. Thank you very much, Nick. As always, thank you to all our listeners. Have a wonderful day. Take care and speak soon.
Thank you.